A stock with a P/E ratio of 8 can be more expensive than a stock with a P/E ratio of 40. That sounds backward until you ask what each price assumes about growth, quality, risk, and future cash flow. In this lecture, we move beyond cheap and expensive, choose meaningful peers, test the numbers against the business, and build an investment recommendation that can survive scrutiny. Today, we are learning relative valuation, security analysis, and how analysts turn valuation work into investment recommendations. Relative valuation is one of the most common tools in finance. The basic idea is simple. We estimate the value of a security by comparing it with similar securities. Instead of asking only, what is this company worth based on its future cash flows, we also ask, how is the market pricing similar companies? That comparison can be very useful because investors rarely look at a company in complete isolation. They compare growth, profitability, risk, business model, accounting quality, and capital needs. But here's the important point. Relative valuation is simple to use, but not simple to do well. A multiple may be easy to observe, but choosing the right peer group, the right financial measure, and the right interpretation requires judgment. A stock that looks cheap may be cheap for a reason. A stock that looks expensive may deserve that premium. Our job as analysts is to understand the difference. By the end of this lecture, you should be able to explain valuation multiples, compare companies thoughtfully, recognize the limits of relative valuation, and connect your analysis to a buy, hold, or sell recommendation. Let's begin with the question, why do investors compare companies to peers? The answer is that valuation is partly a market relative exercise. Investors want to know whether a company is priced above or below other companies with similar economics. A company may look expensive by itself, but if it has stronger growth, better margins, lower risk, and more durable competitive advantages than its peers, the higher valuation may be reasonable. On the other hand, a company may look cheap, but if it has weak earnings quality, declining profitability, high leverage, or serious competitive problems, the low valuation may be justified. This is why peer group selection is one of the most important parts of relative valuation. The comparison set must make economic sense. A useful peer group should include companies with similar business models, similar customers, similar geographic exposure, similar growth prospects, similar profitability, similar risk, and similar capital intensity. Industry labels are a starting point, not the final answer. Two companies can be placed in the same industry classification, but still have very different economics. The key idea is this: compare companies that make money in similar ways and face similar opportunities and risks. When the peer group is weak, the conclusion can be misleading. When the peer group is strong, the comparison becomes much more useful. Now let's talk about the logic of valuation multiples. A valuation multiple compares the market value of a claim with a financial measure connected to that claim. That sounds technical, but the idea is very practical. Some multiples focus on common equity. These are equity value multiples. They use the value of common shareholders' ownership in the numerator. Common examples include price to earnings, price to book, and price to sales. Other multiples focus on the value of the entire operating business. These are enterprise value multiples. They are useful when we want to compare businesses that may have different capital structures. EV to EBITDA and EV to sales are common examples. The most important rule is consistency. The numerator and denominator should match. If the numerator measures the value of common equity, then the denominator should normally measure something available to common shareholders. If the numerator measures the value of the whole operating business, then the denominator should normally measure operating performance available to all capital providers. A common mistake is mixing claims. That can make a company look cheaper or more expensive for the wrong reason. So, when you see a valuation multiple, don't just read the number. Ask what value is being measured, what financial performance is being measured, and whether those two belong together. That is the foundation for using multiples correctly. Let's now focus on the price to earnings ratio, usually called the P/E ratio. The P/E ratio compares a company's stock price with its earnings per share. It is widely used because earnings are central to equity valuation. Investors care about earnings because earnings are one way a company creates value for shareholders. A high PE ratio may suggest that investors expect strong growth, high profitability, lower risk, or valuable future opportunities. But it may also suggest that expectations are too optimistic. A low PE ratio may suggest undervaluation, but it may also suggest weak growth, low earnings quality, high risk, or temporary problems that may not be temporary after all. The PE ratio works best when earnings are positive, recurring, and comparable across firms. It becomes less useful when earnings are negative, temporarily depressed, inflated by unusual gains, or heavily affected by accounting choices. We also need to distinguish between trailing PE and forward PE. Trailing PE uses recent historical earnings. It is based on what the company has already reported. Forward PE uses expected future earnings. It can be more relevant when the future will look different from the past, but it depends heavily on forecast quality. The analyst must ask, are the earnings forecasts reasonable? Are margins sustainable? Is the company cyclical? Are estimates uncertain? Is the expected improvement already reflected in the price? PE is powerful, but only when interpreted carefully. Next, let's compare three other important multiples: price to book, price to sales, and EV to EBITDA. The price-book ratio compares the market value of common equity with the accounting book value of common equity. It can be especially useful for financial institutions and asset-intensive firms, where the balance sheet may provide meaningful information about economic value. But price to book has limits. Book value may not capture the most important assets of a modern company: brands, internally developed technology, software, data, customer relationships, and organizational capabilities may not be fully reflected in accounting book value. The price to sales ratio compares the market value of equity with revenue. It can be useful when earnings are negative, temporarily depressed, or difficult to interpret. Revenue is often more stable than earnings. But sales don't measure profitability. Two firms with similar revenue can have very different margins, reinvestment needs, and cash flows. A low price sales ratio may not be a bargain if the company has weak unit economics or limited pricing power. Now consider EV to EBITDA. This multiple compares the value of the operating business with an operating earnings measure before interest, taxes, depreciation, and amortization. It is useful when comparing companies with different capital structures. It also reduces some distortions caused by different depreciation policies. But EBITDA isn't free cash flow. It excludes capital expenditures, working capital needs, taxes, interest, and other business-specific costs. So each multiple tells part of the story. Valuation multiples are popular for good reasons. They are simple, intuitive, easy to communicate, and grounded in observable market prices. They help analysts compare many companies quickly. They can also reveal when a stock appears unusually expensive or unusually inexpensive relative to peers. Multiples are also useful as a reality check. If an intrinsic valuation model suggests a very different value from what comparable firms imply, the analyst should investigate the reason. But multiples also have serious limitations. They are sensitive to peer group selection. If the peer group isn't comparable, the valuation conclusion may be weak. They can reflect market mispricing. If an entire industry is overvalued or undervalued, comparing one firm to that peer group may simply repeat the market's mistake. Accounting differences can reduce comparability. One-time gains, restructuring charges, cyclical earnings, and different fiscal periods can all distort the analysis. Most importantly, a multiple compresses many expectations into one simple measure. Growth, risk, profitability, reinvestment needs, capital structure, and investor sentiment can all be hidden inside the multiple. That is why a disciplined analyst asks several questions. Is the peer group economically comparable? Is the financial metric clean and recurring? Does the company deserve a premium or discount? Does the implied value support the recommendation? Multiples aren't the conclusion. They are the beginning of a better question. Relative valuation also connects naturally to growth investing, value investing, and factor analysis. Growth investing focuses on companies expected to increase revenue, earnings, or cash flows faster than the market or industry. Growth investors may accept higher valuation multiples if they believe future performance will justify the current price. Value investing focuses on companies trading at low prices relative to fundamentals such as earnings, book value, sales, cash flow, or assets. Value investors look for situations where market pessimism appears too strong relative to the company's long-term economics. But the distinction isn't simply high multiple versus low multiple. A high multiple stock can still be attractive if the company has durable growth, strong returns on capital, and a price that doesn't fully reflect future value creation. A low multiple stock can be unattractive if the business is deteriorating, earnings aren't sustainable, or risk is rising. This is where factors become useful. A factor is a broad characteristic used to group securities or explain differences in returns and risk. Value signals suggest a stock is inexpensive relative to fundamentals. Quality signals point to profitability, stability, strong cash conversion, and conservative leverage. Momentum signals show improving price performance or improving earnings expectations. Size signals relate to market capitalization, liquidity, and analyst coverage. These factors can overlap. A complete recommendation should explain the company's factor profile and why the current price is attractive, unattractive. Financial statements help us decide whether valuation multiples are justified. The income statement, balance sheet, and statement of cash flows provide evidence about growth, profitability, risk, reinvestment needs, and earnings quality. Revenue growth matters, but the analyst should ask whether growth is broad-based, recurring, and sustainable. Gross margin tells us about pricing power, cost advantages, and the economics of the product or service. Operating margin tells us whether the company can turn sales into operating profit. Returns on equity and invested capital help us understand whether the company is earning attractive returns on the capital it uses. Cash conversion is also critical. Accounting earnings are more reliable when they translate into operating cash flow. Working capital trends can reveal important signals. Receivables, inventory, and payables should be analyzed in relation to revenue and business conditions. Leverage and liquidity help us judge whether the company can withstand adverse conditions. Capital expenditures show how much reinvestment is needed to maintain competitiveness and support growth. Non-recurring items also matter. Unusual gains, charges, restructuring costs, or temporary accounting effects can distort reported earnings. The key lesson is simple. A low multiple with falling margins, weak cash conversion, and rising leverage may not be attractive. A high multiple with durable growth, high returns on capital, and strong cash flow may be defensible. Now let's talk about stock screening and qualitative business analysis. Stock screening uses quantitative filters to identify securities for further research. A screen isn't an investment recommendation. It is a way to create a manageable list of candidates. A valuation screen may focus on industry, market capitalization, liquidity, valuation multiples, growth, margins, returns on capital, leverage, cash balances, momentum, or earnings estimate revisions. A useful screen balances selectivity and breadth. If the screen is too loose, the analyst may receive too many companies to study. If it is too strict, the analyst may eliminate companies that deserve attention. Screens also have cautions. Data can be stale, definitions can differ across data providers, accounting effects can be temporary. Some databases may create survivorship bias, and many qualitative issues don't appear in a simple screen. That is why quantitative valuation must be connected to qualitative business analysis. The analyst should ask, does the company have a durable competitive position? Is the industry becoming more attractive or less attractive? Is management allocating capital wisely? Is the growth runway large enough? What can cause the thesis to fail? What catalysts could cause the market to revise the stock price? The goal isn't to attach a story to a spreadsheet after the fact. The goal is to test whether valuation, financial statements, and business narrative all point in the same direction. Finally, we turn analysis into an investment thesis and a recommendation. An investment thesis is a clear argument explaining why a security should outperform, underperform, or perform in line with expectations over a stated horizon. A strong thesis includes a business description, a valuation view, financial evidence, qualitative evidence, variant perception, catalysts, risks, and a time horizon. Variant perception is especially important. A stock isn't attractive merely because the company is good. It is attractive only if the current price doesn't fully reflect the company's future economics, risk, or strategic position. The final recommendation usually becomes buy, hold, or sell. A buy recommendation means the expected risk-adjusted return appears attractive relative to alternatives. A hold recommendation means the current price appears reasonably balanced against upside and downside. A sell recommendation means the expected risk-adjusted return appears unattractive because of overvaluation, deteriorating fundamentals, excessive risk, thesis failure, or better opportunities elsewhere. The analyst should also consider sensitivity analysis. Small changes in the selected multiple, growth expectations, margins, or risk assumptions can meaningfully affect the implied value. So remember the full process. Choose comparable firms carefully. Select the right multiple. Interpret the financial statements. Test the business story. Develop a thesis. And connect the evidence to a recommendation.